Welcome to the Friday webinar. This is Aksha Menon, Research Analyst at PMS Bazaar. Okay, let me start by wishing you all a very happy new year. This is our first webinar of 2023. So let the best in stay for us. So today we have our, with us we have Mr. Surjitt Singh Arora, who is the Portfolio Manager and Principal Officer at PGIM. He is an experienced investment research analyst and a fund manager with demonstrated history of working in automotive industry. He has also got himself skilled in equity research, portfolio management, analytical skills, investment banking, and equities. Some of his previous work associations are with Tata Asset Management Company, Prabhudas Leeladhar, and HDFC Securities. I think that is in common for both of us. And before we're moving to the presentation, let me request the participants to not to ask stock-specific questions. And what are the questions? Please post them in Q&A box. So over to you, Mr. Surjitt.
Thank you, Aksha, and wish a very happy new year to everyone on the call. So as we have been highlighting that we will do a presentation for maybe half an hour, and it will be followed by Q&A session. So without much ado, let me share my screen with you guys. So basically today we will be discussing our two offerings on the PMS side. One is our multi-cap approach, which is a core equity portfolio. And the other is a small cap approach, which is the Phoenix portfolio. So currently at PGIM PMS, we have offerings of two products, which are on your screen. So if you look at our history, or if you look at PGIM PMS, we started our journey in 2013. And as we speak now, we have a team of 9 experienced analysts, with everyone having at least 12 to 13 years of work experience in their respective verticals. And we always follow a strategy known as GARP, which is growth at reasonable price. So what we believe are the main pillars for our investment framework is basically 4 buckets. One is our strategy has to be clearly articulated so that our investors understand what they can expect out of this particular portfolios. Again, we try to remain faithful to the product mandate. So let's say if it is a multi-cap approach, we will have a multi-cap approach. If it is a small cap approach, obviously we will have more inclination towards small cap and mid cap oriented stocks. Again, as in any equity investing, the orientation has to be long term. So we firmly believe that over a period of time, if you are in good quality stocks, there is money to be made, and it's about consistent returns to the investors. And we never focus on when the stock will move, because in our experience of 18 to 20 years as a fund manager on the PMS side, I firmly believe timing is no one's cup of tea, right? Timing is beyond our control. So we should not focus on when the stock will move, but our focus is on fundamentals. Our focus is on why the stock should move. What are the fundamental drivers for the stock to perform, right? So instead of focusing on when, we focus on why of the stock. So now if I come to our first flagship product, which is a PGIM India core equity portfolio, as highlighted, this is a multi-cap approach. We invest in structurally strong companies, and we define quality. Now people will ask how you define quality, what you think is quality. So it depends on company to company, fund manager to fund manager, but there are basically 3 main contours which go into defining quality in our understanding. The first is the company has to reach a minimum scale of revenue, right? Because over a period of, let's say, 10, 15, 20 years, the company will demonstrate their ability to scale up businesses. So that is the first criteria which we look at from a quality of business point of view. The second is, given that we are living in an uncertain environment, we are going through a lot of volatility. Last 1.5 years again has been quite volatile. It's better to look at companies which have gone through at least one down cycle and emerge stronger in terms of profitability, in terms of consistency of cash flows. So a company which demonstrates that they are able to generate free cash flow and operating cash flow over a period of 10 years becomes a part of our investment universe. In conjunction to that, if you look at a higher return on capital employed, again over a period of 10 years, because in 10 years we have seen a lot of ups and downs, you have seen at least couple of cycles. So that gives you a good indication of the business strength of the particular company. So let's say, a FMCG company will have a 40-50% ROCE, whereas a defense company might have a 14 to 15% ROCE. So depending on industry to industry, and every industry being different, the drivers of the industry being different, working capital requirements being different, it's better to look at industry to industry, sector to sector, and then put your money in companies which are better than the average ROCE of that particular industry or that particular sector. So we always focus on companies which are market leaders in their particular domain. If you look at my history, I have completed 18 years in the industry. I firmly believe a PMS portfolio has to be slightly concentrated. When I say concentrated, what we believe is around 20 to 25 stocks in our portfolio. As we speak today, in our core equity portfolio, we have around 22 stocks. And if you look at the top 10 holdings, which I will come to in a minute, will be around 60 to 65% of our portfolio. So we firmly believe wherever our conviction is high, we have to build a portfolio and have higher allocation in terms of weightages to that particular sector or that particular stock. Hence, our single stock exposure can go to around 10%, and our single sectoral exposure can go to around 30%. Again, one more question which we get is, whether you take cash calls. Coming back to my point of, it's very difficult to time the market. And with our learning of over 2 decades, we believe that taking a cash call is futile. As a fund manager, as an investment team member, we always think of being invested all the time, right? So we don't pre-decide the extent of cash we want in the portfolio, but cash is a residual thing. Suppose today I don't have much, I see valuations not being up to the mark, or in certain sectors or certain stocks, the valuations are not comfortable, or the risk reward is not favorable. That time, in a short time, we might take some 1 or 2 cash calls. Otherwise, broadly over last many years, we have never taken any cash calls on a portfolio. So this is a broad contour of how we go about our portfolio per se. Now, if I talk about investment framework or the investment process, I think that is the biggest point in terms of consistency of returns over a period of time to the investors. So quickly coming to my quality filters, which I just mentioned in the last slide, we look at 15 years of existence for the company. So in core equity portfolio, you will not see us participating in any IPOs, because we believe that IPOs over last 1.5 years have been more to do with OFS, which is offer for sale, which gives the earlier investor an exit. At the same time, because these companies don't have a 15-year track record, they don't form a part of our investment universe. So that's point number one. Second, as I told you, higher ROC, right? Which I explained, every sector is different, but any company which has a higher ROC and consistently over 10 years period becomes a part of our investment universe. Apart from that, 7 out of 10 years, which is 70% of the time, the company should be able to generate free cash flow, right? So if you combine ROC with free cash flow, and let's say look at last 10 years, they give you a lot of indication about the strength of the business, about the moats of the business, and about the quality of the business. So after putting these quality parameters into account, out of, let's say, 3,000, 4,000 listed companies, we come up with a universe of 180 to 190 companies. The only caveat which I want to discuss with the audience is that this is 75% of our portfolio and not 100%. The main reason being financials or banking and financial industries, right? We can't have the similar parameters for that industry because the drivers for financials, the drivers of banking are totally different from, let's say, a manufacturing or an auto sector, right? So hence, to give a leeway to me as a fund manager, that 25% discretion is given to me, which is outside the purview of the quality parameters which we have defined. Having said that, if you look at our portfolios, I think majority of the companies, even outside the universe, are basically either the leaders or the second best. And again, their balance sheets, their businesses are very, very strong. So from that angle, we normally have a 2022 stock portfolio in core equity approach. Now, once we decide on the quality parameters and once we decide on the universe, The next, ability or the next aspect which we look at in any of the businesses or any of the stocks is basically two to three things. One, the ability of the company to generate its sales and profit greater in the industry over the next 3 to 5 years. If we think that this company has the ability to gain market share or to improve profitability over the next 3 to 5 years, again, after following the quality parameters, it again becomes one of the selection criteria for you in the portfolio. Again, we are cognizant of the fact that a promoter or a company which every 1 or 2 years comes to the market for the sake of dilution, despite the fact that their balance sheet is quite strong, we normally keep aside these kind of companies and don't invest in these kind of companies. So we are not a fan of a promoter diluting or resorting to additional external funds very frequently. Once in a while, it's okay. But if every 1 or 2 years a promoter or the company comes to the market just to take cognizance of the fact that the stock price has gone up or the market cap has gone up without the due need of the funds, it becomes a red flag for us, and hence these kind of companies doesn't form a part of our portfolio. And lastly, again, which is very important, is the track record of the management in terms of capital allocation, right? A company which is diversifying into unrelated business, or let's say a company which is funding their own sister concerns, again, is a red flag for us, and we try to avoid these kind of companies in our portfolio. Again, one more question which I often get is how you inculcate the self-discipline, right? So there are two things how we do about it practically. One, when we think that our investment thesis is not going the way we thought, or let's say the investment thesis is changing fundamentally, we would take the money out of the table and exit the stock. Or the other way around, if we think that our earlier assumptions are not playing out and company is going in a different direction, we will not be shy of booking profits or booking losses and getting out of that stock. So the self discipline is also very equally important. After building the portfolio, we constantly keep on researching on the company. We constantly meet the management. We do a lot of primary research on the company. We talk to competitors and all. So even after that, certain times it happens that the fundamentals get changed, or let's say the promoter thought process changes for maybe the worst, and hence it's prudent for us to take that call and either book our profits or book our losses and get along with the next available opportunity in terms of building our portfolio. So as I mentioned, just to repeat, 2025 stock portfolio, single stock exposure 10%. So let's say today, if I have a top holding at 7% and it doubles, let's say if we get it right and our fundamentals are right and the stock also performs, and if it goes to, let's say, 14 to 15% of our client's portfolio, the first prudent risk mitigating formula is to bring the weight down below 10%. So that's one way to do it. Or the other way is, if we believe that the fundamentals are running or the market price is running ahead of the fundamentals, we might exit the stock and utilize that proceeds for some other stock where the opportunity or the upside seems to be much higher than what we are holding in our portfolio. So single stock exposure at 10%, sector exposure at 30%, and normally we take 4 to 6 weeks to deploy. So when we get the client's money, we don't deploy on day one. Depending on the market, depending on our view, depending on how valuations stack up between companies, between sectors, we take our time and build a portfolio over 4 to 6 weeks. That's what is unique about PGIM PMS. Just to give you an example, because our topic is consistency. So if you look at companies which are consistent in terms of generating profits, consistent in terms of generating sales, what happens is a case point is on the left-hand side, a company return was 41x over the 10-year period, but that was driven by two things. Earnings also grew by 21x over a 10-year period, and the P expansion also happened to a tune of 4x. So normally a stock return is a basis of two factors. One is the earnings growth itself. So if the earnings growth are consistent, the market will reward the company. At the same time, because earnings growth is consistent and the company has been able to generate good cash flows, with time, it also becomes a re-rating candidate. So on one hand, you can project the earnings. On the other hand, which is subjective, is the P multiple given by the market on the basis that the company is consistently delivering on both revenues as well as profitability. And in turn, that is leading to better cash flows. So if you look at the current portfolio of core equity, I will only talk about the sectors. So if you look at currently three main themes, which is also true for CY23 in our view, is one is manufacturing or industrial. So when you talk about manufacturing or industrials, it can include defense companies. It can include companies which are now getting the benefit of PLI, which the government has announced to a tune of $35 billion. Or it can include companies which are doing make in India, like bearing companies. So all that put together, if you look at capital goods and industrial products, that's almost 22 to 23% of our core equity portfolio as of 31st December. Again, the second sector where we are quite positive is autos. So if you look at autos currently, we have around four stocks, and that's around 20% of our portfolio. And the third sector where we are quite positive is banking and financials. So that's around 17 to 18% of our portfolio. The caveat here being, again, taking back to my previous slides, is that 25% leeway, which is given to me, given the investment framework on core equity portfolio, which defines the quality. And because banking cannot be a part of that 75% of the investment universe, the max weight which we can go in core equity on the banking side is around 25%. Currently, we are around 17 to 18% in terms of banking and financial services. And one more sector which is not mentioned here, but incrementally we are adding weight, and which is there in our newsletter, which is available on our website, is building materials. So we believe residential real estate could be a theme to play over next 2 to 3 years, and one can play that indirectly through building materials, which could be cement, which could be ceramics, and so on and so forth. So these are the sectors where we are quite positive. We believe over next 2 to 3 years, industrials, manufacturing, auto, banking, financials, and to a certain extent building materials should do well over the next 2 to 3 years. Now, again, going back to my point of 15 years of history. So if you look at our average age of companies for core equity as of 31st December, it's around 48 years. Again, to my point of higher ROC, depending on industry to industry, our current ROC of the portfolio is 18%, which is, in my view, quite healthy. Again, if you look at the debt to equity ratio, it's very minuscule. 90% of our portfolio is debt free. And if you look at valuation on FY24 PE basis, it's around 24 times. But I will urge the audience here to also look at the earnings growth for our portfolio. So the earnings growth for our portfolio is somewhere around 20-21%. So in context of that 20-21% growth, a 24-time PE multiple looks quite reasonable. If I go to the bifurcation between large cap, mid cap, and small cap, though the caveat being PMS is a bottom-up approach, we never have a particular percentage in mind when we develop a portfolio. It's pure bottom-up, pure research-based. Currently, as we speak, large cap is around 37%, mid cap is around 41%, and small cap is around 15%. And if you look at from an index, if you look at core equity portfolio, the index is Nifty 500. Our overlap with the index is less than 20%. So that also is where we score in terms of differentiation, in terms of our top 5, top 10 holdings. Our overlap with the index is less than 20%. And this is the performance for you. So 1 year we are at 10% plus. We have done better than the benchmark, even on 2-year basis. And the testimony of the investment framework, which I alluded to earlier in terms of quality filters, in terms of building the portfolio, is in the inception date returns, right? So the inception of this portfolio was 8 August 2013. Since inception, we have completed almost 9.5 years now. If you look at our portfolio CAGR, post fees, post expense, it's around 15.3%. And we have beaten both Nifty 500 as well as Nifty 50 from a 9.5-year perspective. And given that equity is a long-term product and PMS obviously is a long-term time frame kind of a product, I will urge investors to look at 5 years and beyond, and a 9 to 10-year CAGR of 15 to 16% is a healthy number where you have been able to beat the benchmark. So now I will move on to our next strategy, which is PGIM India Phoenix portfolio. As I highlighted earlier, this is a small and mid-cap approach. Now, if you analyze the data again for last 9 to 10 years, you have seen that over a period of time, 5-year rolling return, small and mid caps have outperformed large cap by at least 52% in case of small cap, and mid caps have outperformed large cap over a 9 to 10-year period, 95% of the time on a 5-year rolling basis. So there are certain themes which are very peculiar to small and mid cap, right? So here we are only talking about sectors. So sectors like software product development companies, or IT companies, mid cap or small cap IT companies, or let's say a discretionary retail. The way you are seeing the malls coming up, the way you are seeing a lot of apparel stores coming up. So discretionary retail is here to stay. Again, hospitality, we all have seen last 1 year. Once touchwood things opened up, the way we are seeing hospitality industry doing in terms of profitability, in terms of occupancy, in terms of new hotels coming up, it's quite interesting. Again, as I told you earlier, in both Phoenix as well as core equity, we are quite positive on the real estate front. Again, within real estate, we are more positive on the resi side of the business compared to commercial side of the business. And because real estate, we are quite positive on, we also like home building, which I alluded to earlier, which is the building material space. And there are certain companies in chemicals also, which qualify in the small and mid-cap space, mainly on the specialty chemical. And we all know that earlier it was China plus one. Today, people also started talking about Europe plus one. So the size of opportunity for chemical companies in India who have scale, who have very strong balance sheets, decent businesses, I think the runway for growth for all these companies, the sectors which have been listed here, is quite commendable. And this is mainly, you will find it only in small and mid cap. Majority of the companies are not till now into the large cap bucket. So just normally we don't compare a mutual fund with PMS, but just to give a flavor, and just for it's the purpose of this slide is more to give a flavor and more to give an understanding in terms of how PMS is different, right? So normally, given the SEBI mandate, a mid-cap mutual fund has to mandatory, compulsory invest 65% of the stocks in mid-cap. And the definition of mid-cap companies is defined by AMFI, where they give you 101st stock to 258 stock. Whereas in PMS, we don't have such restrictions, right? Obviously, we also look at qualification in terms of market cap, but we are not restricted to 65% has to be in mid cap. Like for in Phoenix portfolio, currently 55% is small cap, mid cap is only 30%. So that leeway or that discretion is more relatively more on the PMS side versus the mutual fund side. Again, if you look at PMS is a customized portfolio, there might be certain clients who are a board of director of some company, and they would have restrictions from their compliance saying that you should not invest in your sector or companies or your company being the board of directors. So in that sense, for these clients, we have a restriction where we will not buy these kind of companies in their portfolio. Again, it's a concentrated portfolio. As I told you, normally if you look at any mutual fund, the average holding is anywhere between 35 to 45 stocks. But in PMSs, and this I'm talking about from an industry perspective, PMSs would be around 20-25 stocks kind of portfolio. So comparatively, it's a concentrated portfolio. So again, in the minds of investors, I'm just preempting one of the questions is it a good time to consider, or let's say, let me put it this way, increase the allocation to small and mid-cap segment? Again, I will give you one or two data points to make things clear. So if you look at, let's say, on the top of your screen, past small cap corrections, right? So we had seen subprime crisis during 2008, 2009. Then we saw China stock market crisis, Greece defaulted. Then again, there was COVID in March 20. And now this year we are, kind of having concerns on inflation. We are going through this Russia-Ukraine conflict, right? So if you look at the drawdowns, whether it was subprime crisis, small cap index was down 75%, whether it was, COVID, when it was down 60%. But after drawdown, if you look at 1 year, 2 year, 3 year kind of a return, at least history suggests that after such a high 75-80% down drawdown, the upside or the catch up is quite stupendous, more prominently in small cap. And then obviously on the bottom end of your screen, you also have data on the mid-cap companies, mid-cap indices, where mid-cap had gone down to 70% in subprime crisis, during COVID around 50%. But then the recovery over last 1 to 3 years has been quite great. So what we believe, and this is all historical data, the extent of drawdowns is a factor in determining risk. But the time taken to recover is the drawdown is the most important factor. And that on the screen is visible that once you get into, again, coming back to my question, your point of quality. So if you are in quality companies and you are not chasing momentum, you are looking for a GARP kind of approach, which is growth at reasonable price, your mistakes would be limited. And if you get that right, then the journey over next 3-5 years after a maybe 1 or 2 year of drawdown could be very exciting, and it will more than compensate for whatever short term impact you have seen on your portfolios or on your performances. So again, normally if you look at Phoenix portfolio, it's a part of two pillars. One is cyclical company, one is structural companies. So in our portfolio, it's a mix of both structural companies also, and certain companies like building material or residential real estate are more of a cyclical kind of a company. So it's a good mix of small and mid-cap companies. Again, as we spoke about core equity, here also, if you look at overlap, it's quite lower than what the indices or what the competition is doing. Our overlap is less than maybe again 20% here. And here again, because it's a PMS and because we have a slightly longer term view in terms of when we build our portfolio and when we buy into stocks, we have a long term holding with relatively the churn being slightly lower. So again, just to give you a context, a core equity portfolio, which is a multi-cap approach, given that it also has some large cap into it and certain, very stable companies into it, the churn there will be 20-25%. That is what at least historically I have done over a period of time. And when you compare to it, a Phoenix portfolio, which is small and mid cap, the overall churn might be slightly higher, maybe at 30-35%, given that small and mid cap, sometimes you have to take calls. Sometimes, if you are lucky, you get the returns in very short period of time. So it's cognizant as a fund manager to take some profit off the table if I'm seeing some other opportunity, right? So we are not married to the stock. We are not, doing any momentum chasing. So if you look at our portfolios, also they are quite quality portfolios, and incrementally we are cognizant of the fact of the value we are paying when we enter a stock for our investor. So again, compared to core, here also there are different parameters, but just one caveat here: for small and mid cap, you have to dilute the parameters a bit because many of the small cap companies are going into the growth phase. So they will require some debt. Initially, that their return ratios, return on equity, return on capital employed will be slightly muted. And hence you have to give a benefit of the doubt to a small and mid cap company. So compared to, there where we are seeing higher ROC, here we are seeing average ROE of more than 8%, again, over a period of 10-year time frame. Again, if you look at there, we were talking about free cash flow. Here we are talking about operating cash flow, because the capex requirement for small cap companies when they are in the growth phase will be higher, and hence the free cash will not be the right parameter to look at least in the initial growth phases of these companies. Hence, we look at the operating cash flow again, 6 out of 10 years. There it was 7 out of 10 years. Here it is 6 out of 10 years. And currently, if you look at our portfolio, the market cap could range between 750 crores to 30,000 crores. But currently, as we speak, the average market cap of Phoenix portfolio is around 15,000 crores. So this is similar to what we discussed earlier. So with this, I will stop and thank you so much for your time. I will more than happy to take your questions. Thank you everyone for patient listening.
Thank you, Mrs. Surjitt, for enlightening us with two beautiful portfolios. One is core, which is multi-cap, and the one is Phoenix, which is small and mid-cap. Thank you. I do have some set of questions to put it forward. So let me go for a top-down thing. So let me start off with macros and then drop into PGIM. The thing is, the one question which is very common and everyone asks for fund managers: how do you sum up 2022 and how do you see 2023?
On a lighter note, we are in an uncertain environment, right? So 2022 was also uncertain. 23 also would be quite uncertain given the way macros are shaping up. So in one word, it's uncertainty which we have to deal with.
So you feel the uncertainty is going to continue in 2023 as well?
Yes.
And actually we could see the volatility in market as well. So when you say that the uncertainty is going to prevail, like what are the headwinds India should battle in 2023 according to you?
Yeah, very good question. So I will break it up into 2-3 aspects. The first is external. So if you look at, as I mentioned earlier, the Russia-Ukraine conflict, No one can predict what will happen going forward, right? So that's the biggest uncertainty the world is facing, whether it's through inflation, what will happen to gas prices, what will happen to crude oil prices. So that's the biggest uncertainty where no one has any answers to right now. So we have to be very cognizant of the fact that it can go either ways, right? Point number one. Second, if you look at inflation, obviously we are living in a globalized environment. If globally things are not doing well, the litmus test of that is crude also is now coming down, right? Because Europe has already gone into recession. We are talking about US going into recession. Some IT companies are already hinting that recession is here to stay in US. Maybe the time frame might be shorter, but still it is there. And with the rising interest rates in US also, I think India has not decoupled. So we did one exercise where we found out over the last 10 to 15 years, if you look at the correlation between Indian equity markets compared to US equity markets, it's around zero point 0.7. So yes, last year domestic flows were quite strong, and hence our impact was quite lower, and we were able to outperform. Otherwise, if you look at, given we are quite globalized and a lot of our companies are also exporting and also importing a lot of stuff, we can't have a blind eye towards the global growth which is slowing down. So that's the second thing which we need to keep in mind. And this was on the negative side. So one is Russia-Ukraine conflict. The other is that globally interest rates are rising. Hence, the global demand, both in Europe and US, is slowing down. And that somewhere will have some impact on the Indian entities also going forward. On the positive side, now we all talk about negatives, but let's also focus on a couple of positives. If you look at inflation, right? If you look at because of this global slowdown, lot of commodities which saw their peaks in the month of April this year, sorry, last year, April 2022, whether it's steel, aluminum, copper, to that matter, even crude, all have corrected 25 to 30%. So if this sustains going forward, given that India is still a net importer, I think it will augur well for the overall profitability of corporate India. So that's point number one. And in conjunction to that, obviously, if you look at FIs, right, the broad allocation for them on a global arena is basically if crude is below 100, they might increase their allocation to emerging markets. The moment crude goes above 100, obviously they are kind of the first ones to take their money out of the table. So depending on where the crude settles, and given that whatever inputs we are getting from the global economy in terms of slowdown, I think it's a guess, no one can predict, but it's a guess that if crude remains in that $80-90 band, then it augurs well for the emerging markets. So maybe in next 3-6 months you will see FIs also coming back to the Indian markets.
Okay, thank you. Thank you, Surjitt. One more question is that Praveen Kumar, he wants to know if would be interested to understand the China plus one factor. Is it really playing out or just an hype happening?
So yes, sir, you are absolutely right. It is playing out, but not to that extent which we envisaged, right? But to put things in context, our chemical companies are so small in terms of scale. Even if they get 2-3% of the incremental uh, orders, so let's say the orders which are getting from pharmaceutical companies or from global agrochemical companies, we can have a long runway to growth. So you are absolutely right. A lot of things are going to Indonesia, Vietnam, other countries also. It's not that India is only getting the disproportionate share of China plus one. But the fact of the matter is, if you look at the current capex, which has been announced by specialty chemical companies who have strong balance sheets and who have, the scale and the technological ability, the capex itself is giving you some idea that some portion of that, difficult to pinpoint a number, but some portion of that is definitely coming to Indian entities, and hence they are setting up huge plants, which gives them visibility of over next 5 to 10 years in terms of setting up the molecules or setting up the intermediaries required for both pharmaceutical as well as agrochemical companies.
Okay. So one more question. I think Praveen, your question is answered. So moving on to the next question, which Nimesh asks is like, why 99% of PMS fail to beat mutual funds over the longer period of time? Is it true or false? I don't know. Like, over to you, Mr. Surjitt.
Frankly, I can only speak about our process and PGIM as a house. It will not be right on my part to comment on anyone else. But to just give my thoughts on overall PMS scheme, as I told you earlier, PMS is a concentrated portfolio. And over a period of time, if you are into quality, if your research framework is right, if your investment process is right, and if you can, cut down on your losses or cut down on your mistakes. So I will give you my anecdotal evidence, right? in my 18 years career, the biggest learning for me has been I don't have to get all the 20 stocks right? Even if I get 60 to 70% of my stocks right, but my allocation to that particular sector or to that particular stock is higher, I am true, right? So obviously, we are human beings. We will make mistakes. Sometimes, even after doing our research, sometimes one or two cases it might happen that we were not able to anticipate the change in, the environment or the change in the management and all. But barring that, in my experience of 18 years, I firmly believe a 60 to 70% strike rate, uh, and with decent allocation, because sizing of your opportunity is also very, very important, specifically when it's a PMS portfolio and specifically when it's a concentrated portfolio, right? So hence I alluded to the fact that my top 10 holdings, if you look at core equity or Phoenix portfolio, the top 10 holdings is 60 to 65%. So if my top 10 holdings, let's say 6 to 7 do well, right? Then we are true and we will do a better job in terms of delivering consistency in terms of returns over a period of time for our investors.
Okay, thank you. Thank you, Mrs. Surjitt. The one more question from Praveen is that what's your take on India consumption story versus export oriented story? Most of it, MFs are towards India story. Now to be dependent on export oriented companies.
Absolutely. Your reading is absolutely right. So last year, if you look at our portfolio also, CY22, we were domestically inclined. So obviously, as you are hinting, we were also more towards domestic oriented companies because the domestic environment or the domestic consumption was thriving. So just to give you anecdotal evidence, last 1 year, because of this opening up trade, a lot of urban consumption happened, lot of discretionary consumption happened, right? So because our economy is so big and our consumption profile is so huge that a lot of companies were not even able to, generate enough production to take care of in-house consumption, right? So that's why, because there was a pent-up demand, there was a discretionary spending. Incrementally, fund managers like us were tilting towards, domestic companies. At the same time, global environment, as I alluded to earlier, is still going through a difficult phase. We are living in a very uncertain environment. Europe is slowing down. Recession already is there in Europe. US already is talking about recession. Rate hikes are still going on in US. So if you do the math, maybe in the first half of this year, this trend will continue. And once we see a pause from Fed, or let's say even globally things stabilize, and once we are through the phase of big time slowdown, I think eventually again people will start looking at export oriented companies. Like for example, if I just have to give you one example, auto ancillary as a sector, it has huge potential in terms of exports, given that it's make in India, given that our Indian labor and Indian capital is relatively cheaper. A lot of companies have the ability to make in India and export it abroad, and the quality of the products is also very good. So yes, I will not totally write off export oriented companies, but I still believe we are still 1 or 2 quarters away before taking that call of going overweight on export oriented companies vis-a-vis what the domestic companies are doing.
Okay, thank you, thank you. One more question from Lakshmi Gupta. Is it right time to invest in international market, like 2 to 3 months from now?
So basically, what happens is again it's a point of asset allocation, right? It depends on individual investor. It depends on the distributors who guide the investors. So my sense is there is no hard and fast rule or there is no thumb rule to give you a number. But I will just share my experience and whatever I've learned over a period of time is that any individual investor, right? He should have a bouquet of products, and given where we are currently, we should have not more than 5 to 10% exposure to international funds. So this is my personal view. I think still, given that whatever we are seeing around the globe, and given that our own companies are growing at 15-20% in terms of earnings, with the kind of pristine balance sheets which we have, I think yes, it's good to have some diversification. But in my assessment, in my learning, I think a 5 to 10% allocation to international funds in your overall asset allocation should be how you should position oneself in terms of investments.
Okay, thank you. The next question from Abhishek, because we are bombarded with a lot of questions for today. So with increase of rates and money moving towards debt and banks, FDs, Nifty last year return was only 3%. Can we expect an equity market to give negative returns in 2023? This is what is special.
Sir, I don't have a crystal ball to give you that answer, but I can give you one perspective. See, as you rightly said, the return for Nifty last year, that is CY22, was 3 to 4%. But if you look at in context of other markets, right, other markets were down 15 to 20%. I'm talking about the calendar year 2022, right? So in that context, we definitely have outperformed. Obviously, I'm a long-term portfolio manager, so near-term headwinds will be there. But from a long term, I still believe equity is the asset class to be in. But as you rightly said, given where the interest rates are, given where the uncertain environment is, at least for next, again, it comes to asset allocation, right? So if you are, let's say, 100% allocation to equity right now, I think at least 20-25% should move to debt, given where the interest rates are. And as I mentioned in my earlier remarks also, if you want to diversify, 5 to 10% could go to international funds also. But again, it depends on asset allocation. It depends on how you want to play. But from a 5 year perspective, obviously, I have been in the market for the last 18, 20 years. I still believe from a 5 year perspective, if one is coming into equities and one is coming into good quality names, I think money is to be still made in equities, despite the fact that near term interest rates are going to inch up.
Okay. Thank you, sir. And Ved Prakash wants to know the CAGR of Phoenix portfolio.
Historically, right?
Yeah.
So I think, there is one change which I would like to highlight. I joined PGIM PMS in the month of August 2021. Prior to that, it was more of a value-oriented approach, right? So this is very important for you guys on the call to understand is because it was a value-oriented approach and nothing right or wrong, but value as a strategy did not work prior to 2021, 22. So 4-5 years, there was a lot of slight underperformance when you look at the benchmarks. And when I came in the month of August 2021, I did 30 to 40% changes in the portfolio with a connotation of growth at reasonable price. So incrementally, the stocks which I added were replacing value-oriented stocks, and that 35-40% of stocks were growth-oriented. Because of that, today, if you look at since inception, we started this portfolio, I think, in 2016. We have completed almost 6.5 years there. 6.5 years, we have given some 11.5% CAGR, which is not great. But my only submission to you is when I came on board, our CAGR was not even 7%. So in last 1.5 years, we have been able to turn it around. And today, a 6 year CAGR is also 11.5, where we are already beating Nifty small cap 250. So my endeavor obviously is to improve it. But if you look at last 2 years, it has been very, very volatile for small cap index. I mean, last year also when small cap was flat, or let's say it was down some 5-6%, we had generated a positive alpha of 8%. So we are positive 3%, and the index was down minus 5%. So in that environment, if you are able to protect the capital of the investors, and that's our topic for today, right? Consistency. Yes, we also got hit, but because of relatively better quality portfolio, we were able to generate 7 to 8% alpha. Last 2 years have been difficult for small cap. It might happen, it might continue for some time. But as I showed you in my, one of my slides, that the drawdowns, the way they are in small cap, when the recovery happens and when things start to change for the positive, the upside could be very, very huge in small cap. And last point from my side on this point is, if you look at small caps also, over last 5 years, the biggest positive for Indian corporates has been deleveraging of balance sheets. So even if you look at small cap companies, let's say 2,000, 3,000 crore market cap, a lot of companies are either debt free or their net debt to equity despite capex is 0.5, 0.6, which is commendable from an equity investor point of view, right? So we also are cognizant of the fact that yes, they need capex, they will require some funding, but if they are managing their balance sheet and if their net debt to equity is not more than 1.5x, we are comfortable with investing in these kind of companies from a slightly longer term point of view.
Okay, thank you. That was well explained one. Thank you. So let me come back to my questions. Is that 2023, there are a lot of interest rate hikes happening. So, but it is not yet settled yet. So we can expect more interest rate hikes as well. How hard will that affect our equity markets?
So see, as I told you, our understanding, and this is our internal understanding, we still believe there might be 1 or 2 more hikes pending in the US market. And as you rightly said, normally interest rates going up will have an impact on the PE ratios, because we look at the earnings yield and the the 10-year bond yield for our markets also. So still from that angle, the risk reward is not that favorable. But my sense is this year, CY23, difficult to time, but CY23, you will see a pause from Fed. If that happens, and obviously India will mirror what international markets are doing from an interest rate point of view. If in India also in next 1 or 2 quarters, we take a pause in terms of interest rate hike, and as I alluded to my earlier remarks of inflation coming down, last 2 months, the inflation print has been quite uh, interesting, and it has been in line with what RBI has been guiding, right? And with metals now correcting, with crude also correcting, and with some blessings of God, we might have a situation where in second half, our inflation might be under control, and then the incremental increases in interest rates will not be required. Once the market anticipates that, the peak of interest rates is there and it's behind us, I think you will see the underperformance of equity getting caught up, and incrementally, maybe in next 3 to 6 months, equity again will be a flavor of season in my view.
Okay, but Sid, I have one more question as well. We can see IPOs in 2022. It didn't do as good as it was expected to do. So probably because of oversubscribers or overvalued. And latest, which is Mama Earth, which is on trend, which has PE of 1,000. So we could see a lot of comments saying that we could see a lot of things out there in internet. So how do you see this IPOs? Do you think the IPOs of 2023 will be overvalued, or what is the exposure that you give to IPOs?
So I will go back to our investment philosophy, and this I'm talking about PGIM as a house, right? So as a mutual fund, as a PMS, we are very clear about our investment process. So as I told you, if I go to my previous slide on core equity, we need 15 years of existence, right? We are old school people. We take profit into account. We take the pricing power into account. We take cash flows into account. As you rightly said, last 1 year, 1.5 years, and this is our learning also. We have not invested in any of the IPOs. Majority of the IPOs we did not invest for two reasons. One, these were not profitable businesses. Second, as you rightly said, we are old school. We look at profitability, we look at EBITDA, we look at other parameters. Here, companies were giving valuations on revenue, which in our 18-20 years career we have never thought of. So obviously, we are doing that research. We are not saying we are turning a blind eye to our IPOs, but our understanding is very simple. If you analyze CY22 IPOs, majority of them were offer for sale. When you say offer for sale, it's the older investors who are getting exit. And you and me both know, why will an investor give you when he comes for an exit, obviously he will want a particular price. If I have to sell something, I need a particular price before which I will not come to the market. So no straightforward answer, but my only submission to the audience here is, please do your due diligence. Don't get carried away by the oversubscription. Look at the fundamentals of the business. The basic parameter is the company should have scale. The company should have checkered history, or at least some history, and you should follow the basic contours of profitability, cash flows, and all before jumping into any of the IPOs. And be sure that whether it's actual funds which are required by the company to grow, or it's more offer for sale, where they are giving their existing investors an exit, and that's why they are coming to the market. So one has to be very cognizant before going into IPOs.
Okay, thank you, Mr. Surjitt. And you have a compliment from Mr. Nimesh saying that you're very honest, and he wants to congratulate on you. I want to say that.
Thank you, sir. Appreciate it.
Yeah. And one more thing is that about you were quite bullish about the automotive industry. So we could see this metaverse coming in, and there are a lot of innovations into automotive industry. I mean, you can see auto expos in pan world, which is going around in 2023. So you think this automotive industry will be will do great in 2023 as a sector?
Yes. So I will give you 2-3 pointers from my side, because this is my forte. I have done autos for last 18 years. So pardon me if I go a bit longer on this. But there are 3 aspects you should look at from an automotive industry, right? As you rightly said, there is a change in terms of innovation, there is change in terms of technology. So there, I believe the best way to play the automotive industry, the innovation or the tech, which is getting into all the new cars, is through mid-cap IT companies. So any IT company which is into R&D space, which is engineering and R&D space, and mainly catering to automotive, I think they have a long runway to grow. So that's point number one. Second, if you look at the erstwhile auto ancillary or the auto OEM companies, depending on their product life cycle. So if you look at, as you rightly said, I was also there yesterday in Auto Expo in Delhi. So I had gone to meet various companies there. The biggest thing was, one, technology is changing. So everyone has a EV, everyone has a CNG oriented product, and the people on the call might be, positively surprised that now hydrogen fuel cells are also seeing the light of the day in the commercial vehicle space, right? So depending on whoever company is better in terms of technology, or who are starting to gain market share, or whose product life cycle is now getting better. Just an anecdotal evidence, if you look at Indian passenger car market, I mean, last 5-10 years, even you and me, right? From a aspiration point of view, we are not going for smaller cars. We are directly going for SUVs.
Yes.
And if you look at the data also, today 35 to 40% of our Indian passenger car industry is SUVs, which I believe over next 3-5 years could be maybe 45-50%, because any person who upgrades in life wants to upgrade from a small car to directly to SUVs. Hence, the sedan segment is getting compensated by more SUVs selling. So yesterday in the Auto Expo also, a lot of new players, a lot of incumbents also had a lot of SUVs in their halls, right? So that's second. And third, as I mentioned earlier, the raw material cost which is coming down, which we have seen from the peak of April. Now we have seen already 25-30% correction. Normally, consumer facing company, B2C company, don't take price cuts. So these companies have already taken price hikes in last 1 year in anticipation of inflation, in anticipation of metal cost going up. I think now it will be a litmus test for them, where over next 2-3 quarters, we also, will do our research, and we also get to know exactly what will happen. But our hunch is that because of this material cost correcting, and they are not correcting the prices of the end market. You look at any cars today, no car is cheap, or no car manufacturer will give you any discount. So from that angle, your pricing is fixed, but your raw material is coming down. So ideally, logic says your profitability is bound to improve. So again, to my point, you have to go bottom up. It's not that you paint every company with a similar brush. You have to go bottom up. If you look at our portfolio, we have different stocks in auto, all with different drivers in terms of what will pan out. But yes, I believe from a manufacturing angle, with PLI also coming in play, I think auto and auto ancillary could be one of the themes to play in CY23.
Okay, thank you. That was a well explained one. Thank you. And if you were given a choice, it's just my personal question, if I could ask you this. If you are given a choice of choosing a good business or a good business leader to select a stock, so what would you prefer? Good business or good business leader?
It's a very challenging question, I should admit. So again, I will be more diplomatic here. Sorry for that.
Okay.
But frankly, see, end of the day, certain businesses, you need a good business, right? Because if the business is fine, everything is fine, processes are in place, anyone coming on the top can take it way forward. But in certain businesses, you need that visionary person, because if that person comes in and if he turns around that business, then there's a money to be made for investors like us. So depending on, again, there's no straightforward answer to this, but sector to sector, company to company, and depending on which competitive intensity is there in particular industry, you have to take it one by one and in terms of bottom up approach, rather than, again, to give a simple number and say that this business is better, or a better business is good, or let's say a visionary is good. So it depends on, company to company and sector to sector.
Okay, thank you. Do you feel India has been overvalued because of late because of market being volatile and FIS buying and selling is happening very often these days, people feel that India has been overvalued. So and that's why the market being volatile is. So what is your opinion? What is your take on this?
Yes, if you look at very short term, let's say, though we don't talk about a quarter or two, but from a very short term perspective, yes, given that we have outperformed last year, as I told you, right, we were 4% up and the other markets are down 15-20%. The outperformance has been huge. So somewhere there has to be a sanity to that, where incrementally the markets which have underperformed. Case in point, if you look at last 1 to 2 months data, China has outperformed big time, right, within emerging markets, and India in last 1 month has been underperforming. So yes, from a global allocation point of view, these things keep on happening. But again, alluding to the fact that we are here for 3, 5, 7 year time frame from an investment perspective, I think barring 1 or 2 quarters where you might see some time correction due to the valuations not being Once you look at the earnings coming in, companies generating whatever 12, 15, 18% kind of earnings growth, again, we will be in a very sweet spot. And as I alluded to earlier, if interest rates, the biggest trigger for world markets and specifically emerging markets will be once Fed gives that hint that this is what they are going to do in terms of interest rates, or this is the peak. I think markets will take it very, very positively.
Okay, thank you. But saying that, you said everyone goes for a bigger buy. As life takes you, even you go bigger. So with that, the number of ultra HNI clients, in India, it's increasing exponentially. Gradually, it's increasing exponentially. So what are the difference that you feel for traditional investors and this new age ultra high net worth investors? What are the risk taking appetite? What are the difference that you feel between them?
So again, just to give you a very anecdotal evidence, and you guys are also privy to that, is that let's say 10 years back, the only asset class from an equity point of view was mutual fund, right? And because of thanks to SEBI and thanks to AMFI, the kind of marketing they did, and now you are seeing a lot of SIPs, 13,000 crores, 14,000 crores SIP sticking to mutual funds, right? So these are investors who have come to market maybe 5 years, 10 years back. Now, as you rightly said, the ultra HNIs who have made money or who understand markets, right? Now they are at a certain space in terms of their net worth, in terms of what they can, their ability to take risk. So that's why alternate as a strategy, whether you call it PMS or whether you call it AIFs, these both are the part of alternate investments, right? This segment in last 3 to 4 years has boomed, and you have the data with you. This segment, both in PMS and AIF, has seen a lot of HNIs flocking to them. And incrementally, I think over next 5, 10 years, PMS and AIF will do very well. The simple example of that is HNI who used to invest in mutual funds earlier. Now he has already done it already invested in that incrementally because he's a HNI. He wants a customized portfolio, right? He wants something extra in life. He wants one more layer of investments. So then, hence PMS came in. Now that PMS has kind of stabilized itself, now because they HNIs in SEBI guidelines also. Earlier, if you remember, PMS was 25 lakhs ticket size. Now it's 50 lakhs. Similarly, AIF is 1 crore. There is a rumor in the market it might go to 3-5 crores. We don't know. But the moment people aspire in life, the moment people earn in life and go for bigger allocations, they also need something unique, something customized product, right? So from a basic plain vanilla mutual fund, uh, they went to PMS. People who have graduated from PMS, and because they have a lot of money with them, and as you rightly said, they are ultra HNIs, they will have quite a good mix of PMS as well as AIF, right? So my sense is because the journey, again, simple example of Maruti or any other company, because the journey has been from small cars to SUVs. Similarly, for here also, mutual funds will go to PMS. I'm not saying they will not have any allocation to mutual funds, but within that, they will diversify. As one of the queries of the participant was mutual funds, PMSs, maybe AIF, and then some international funds. So it all boils down to asset allocation. It all points down to how one's advisor takes your risk appetite into view and what is your goal in terms of what you want to do in next 20, 30 years. Hence, asset allocation becomes a very important part of your portfolio.
Okay, thank you. It was well answered.
Thank
And
you.
there was one more question, because we are going to end our webinar as well. We have already crossed a minute from 5:30, but still, I want to ask this because the webinar is getting more interesting. You spoke about your investment strategy. What is your exit strategy for from your portfolio?
So as I told you, end of the day, if we go wrong, right? Because at the end of the day, every human being is prone to make mistakes. But if we go wrong, we take immediately actions on that, right? So if we think the thesis with which we bought a particular stock is not working, or there is some change in that thesis, or some change in the external environment, or maybe the management is not taking steps in the right direction, then we will, cut our losses also. We don't shy from cutting our losses and just exit that stock, and we'll look at a better opportunity or better stock to look at, or let's say opportunities cost is very, very high for any investor. So rather than thinking of or only hoping, because hope is not a strategy, so rather than hoping that things will turn around, if we think that our thesis has been questioned, or let's say whatever we had thought about this company is not panning out the way we anticipated it to be, it's very easy and humble to accept that and move on and cut our losses. So that is what we have done over last 1.5 years in PGIM. And earlier I was in my earlier avatar also at Tata. I used to do that. Wherever we get it wrong, it's better to cut your losses and use that same money for some other opportunity, which might give you a potential upside, which is much better than what you were having in your portfolio.
Okay, thank you. With last two questions, I want to wind up. We have two more questions to go. It's just that how do you allocate your corpus between your core equity and Phoenix portfolio? How do you allocate it?
So again, it depends on customer to customer. Normally, what I say is a person who is slightly conservative by nature, he should come in core equity because it's a very stable approach where we have 40-45% allocation to large cap. So it will give him a stable, consistent kind of a return. Whereas a profile of a customer who understands equity, who is able to take risk, or as you told it, ultra HNI, right? Who understands the risk and the volatility in the equity markets, there we normally recommend a Phoenix portfolio because by nature of that portfolio, 55% is small cap and 30-35% is mid cap. So again, no straightforward answer, but depending on the investor, the profile, the risk appetite. Normally, I will urge you should come in one portfolio rather than having the combination of both. Because if you combine both, because we have 22 stocks each, and there are only two common stocks between core and Phoenix, you will again have 40 stocks in your demat, right? It will again become like a mutual fund. So the whole purpose of concentration of the portfolio, purpose of focusing on a particular 3-4 themes will go for a toss. So my humble request to the audience is, if you're looking at the portfolios, look at each portfolio differently, and depending on your appetite, depending on your understanding, if you want stable returns with not much risk, it's better to be in core. If you are able to take that slight higher risk with the anticipation of better returns or higher returns, you can move to a Phoenix portfolio.
Okay, I think that would answer a lot of questions which is coming up. And with this last question, we're going to come to the end of the session. So the last question is, what is the unique selling point of PGIM that which makes PGIM differentiate from other PMSs?
So as I alluded to earlier, right, if you look at our overlap, whether you look at from a mutual fund angle, whether you look at from a benchmark angle, our overlap is less than 20%. So even let's say to your point, if there is an ultra HNI who already has exposure to PMSs, if he adds a PGIM PMS to his bucket, let's say he already has 3 PMSs and he's looking for one more PMS. If he adds PGIM PMS to his bucket, one, there will not be much overlap. The overlap will be less than 20%. So within PMS, he's able to diversify. And second, with time, the theme of this presentation is consistency. So if we are consistent in our approach, if our investment process is right, and if over a period of time we are able to generate decent return for our investors, beating the benchmark, I think we would have done a decent job for our investors.
Okay, thank you, Mrs. Surjitt Singh Arora, for enlightening us with for 1 hour for very thoughtful thing. And of course, questions which aren't answered, I would request you to pose the same questions at events at PMS Bazaar. I would request Surjitt to answer them, so that we'll be sending the answers across to each and every participants.
Will do, definitely.
Yeah, thank you all for your patience. We are 6 minutes past 5:30.
Thank you, PMS Bazaar, for this opportunity, and thank you, participants, for coming on the call.
Yeah, and I would thank everyone, and I wish you a happy New Year.